Every 6 weeks, one meeting in London can move the British pound by hundreds of pips in a matter of minutes. If you trade GBP pairs and you are not watching the Bank of England, you are trading blind. The Bank of England, the BOE, is the central bank of the United Kingdom. Its main job is to keep inflation stable and support the broader economy. The primary tool it uses is the base interest rate, sometimes called bank rate. When that rate changes, or even when the BOE hints that a change might be coming, currency markets react fast and often hard. Here's the mechanism. A committee of 9 people, called the Monetary Policy Committee, meets roughly every 6 weeks to vote on whether to raise, cut, or hold the base rate. That vote, including how each individual member voted, gets published alongside the decision. The split matters. A 7-2 vote to hold rates tells a very different story than a 5-4 vote. The closer the split, the more uncertain the outlook, and uncertain outlooks move markets. When the BOE raises rates, UK assets become more attractive to global investors because they offer a higher return. Those investors need British pounds to buy those assets. Demand for sterling rises, and so does its value. Cut rates, and the logic reverses. The pairs most sensitive to BOE decisions are GBP-USD, EUR-GBP, and GBP-JPY. On announcement days, GBP-USD alone can move 100 pips or more within minutes, and that is when the decision matches expectations. When the outcome surprises the market, moves can be sharper still. One thing newer traders underestimate is the power of language. The BOE publishes a full written statement alongside every decision. Words like persistent inflation or resilient growth carry real weight. A rate hold paired with hawkish language hinting at future rises, can push the pound higher just as effectively as an actual rate increase. Learning to read that language takes time, but it sharpens your edge across every BOE cycle. A practical note on announcement days: the initial spike after a release is often noisy and can reverse quickly. Waiting for that volatility to settle before entering a trade means you might miss the first 30 or 40 pips, but it also means you avoid getting stopped out by chaos rather than conviction. Wider stops and reduced position sizes on high-impact days are not signs of weakness. They are signs of experience. Trading around central bank events involves real risk. Only ever trade with money you can afford to lose, and keep your position sizes honest when volatility is elevated. Before the next BOE meeting, check what the market is already pricing it. Then read the statement word by word. The number is only half the story.